Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Monday, August 8th. Before we get started today, I just want to let you all know that there is a free event that I'm hosting over at earningsbeats.com. It starts at 4:30 this afternoon. It's really a big event for us. We have portfolios that we design and we track, attempting to outperform the S&P 500. And tonight's event at 4:30 is our top 10 stock picks sneak preview, where we'll talk about how we put these portfolios together and their performance and any changes that we're making, and talk a little bit about maybe some of the stocks that we'll be looking at as well. Some stocks that have reported some great results and are performing really well on both an absolute and relative basis. So this is a great event. Anyone who is an Earnings Beats Digest subscriber, that's our free newsletter. If you scroll down over at earningsbeats.com, you'll see an area where you can sign up for our free EB Digest newsletter. This is a newsletter published 3 times a week, Mondays, Wednesdays, and Fridays. Comes out in the morning, usually about an hour before the market opens. Normally, it's focused on earnings. Obviously, that's a big thing that we look at Earnings Beats. Also, gaps, candlesticks, trend lines. I mean, most things that most technicians look at. But it'll give you our slant on the market, the way we approach the market. I think will help. We try to make it very educational in nature. So if nothing else, maybe you just pick up a couple things that will help in your trading or investing as you go forward. All it takes is a name, email address, hit that subscribe button. No credit card required. We'd love to have you. So again, if you go in and you sign up for this newsletter, later today, we will be sending out room instructions to our Earnings Beats Digest community, as well as all of our members, for this event that starts at 4:30. We'd love to have you. Okay, before I get into the 5 charts that I want to give you today, because I'm very bullish. I have turned bullish. I actually called the bottom June 16th. There was actually a slightly lower low on June 17th, but essentially June 16th was the low close. So I feel like I pretty much hit the bottom. I'm going to talk a little bit about it. There was an article that I wrote, though, recently in my Trading Places with Tom Bowley blog over at StockCharts, and I'll show you how you can get to this. But I wanted to show you a little bit about what's at stake right now in terms of being in this market now on the long side. But before I do that, I'll show you how to get here. So if you're over at the main page at StockCharts, what you want to do is click on articles. And there's a lot of fantastic authors here at StockCharts. Once you do that, though, you can then go down to my blog, which is Trading Places with Tom Bowley. And then if you go down, it's probably 3. I wrote an article over the weekend. Stay away from the news, focus on the charts. Talked a little bit about an industry group and how August tends to be very strong for that group. And then if you go back to my 3rd article, a little over a week ago, I wrote this article, We're Heading for New All-Time Highs. Now, in this article, the thing I want to focus on is this Excel spreadsheet that I have right here. So I do a lot of research in the stock market, and cyclical bear markets are something that I've studied a lot. I've also studied secular bear markets. I said at the beginning of the year, I thought we were going to have a cyclical bear market. I even gave a target, 3,500 to 3,800, which we went right down to. I gave a time frame, 3 to 6 months, suggested that we would bottom in June. It was a pretty good forecast. Not gonna lie. Now we got to June. I'll show you in some charts. I'm going to show you in just a minute why I called the bottom in June. But at the bottom, it's important to understand not just this cyclical bear market, but all cyclical bear markets. These are all the cyclical bear markets, the start and the end, since 1950. So when you look at this is a list of 11. There have been 11 of them. So 2022 becomes the 11th in what I believe is cyclical bear. Some folks will argue and say that it's a secular bear and we're going back down. Hey, this is a market. You can take either side. I'm going to tell you why I believe it's cyclical. And I do believe it's cyclical. I think it's over. I think we're now resuming the secular bull market. But the thing to understand here with these cyclical bear markets is once they bottom, when you look at the return 1 year later, The average 1-year return off of a cyclical bear market bottom is 42.6%. That is nearly 5 times the average annual return on the S&P 500. Spotting these bottoms spotting these bottoms is incredibly important because of that first year return coming out, or even the 6-month. Look at the average 6-month return, 28.67%. Once we bottom and start moving up, everyone that doesn't get in is always like, well, it's got to come back down. If it comes back down, I'll get in. That's usually not the way it works. You got to be really careful. So I just want to point out before we look at these charts, this is what the potential is. If I'm right, and I believe I'm right, but if I'm right, and June turns out, that mid-June bottom turns out to be the bottom, this is the returns, anywhere from 29.5%, which was 1990 cyclical bear market. That was the 1-year rally. Up to 78% was the highest. Somewhere in between, the average is 42. I've already gone out on a limb and said I think this one's going to be 40 to 50%. I believe will be minimum 40 to 50% higher from June 16th, 2022 to June 16th, 2023. That's what I'm thinking. We'll see. Anyhow, let me show you the 5 charts that are really important to me in calling this bottom and then simply following the action, looking for confirmation. The first, the S&P 500. Now, this is a key area on the S&P 500 for a couple of reasons. Number one, the last reaction high we had off the May low went up to 4176 on the S&P 500. If I update this right now, this is intraday. Right now, we're at 4179. We got to 4186. Intraday, we are trying to make this high. I already find that to be bullish. The fact that we made a higher high, even if it's intraday, I find to be bullish. Now, if we weaken later today and we close well off the highs with a false breakout, I could see a little short-term pullback. I doubt it would be anything below the 20-day moving average. So I'm not looking for any kind of a big move. If we were to lose 3 or 4%, that would be a 3%. I would say that would be a pretty sizable move at this point. I wouldn't be looking for much more than that if we get it. Many times off of these cyclical bear market lows, we go up and we don't even see a 20-day test for a while. This is normal on the breakout above the moving averages. This is normal historically to come back and test them. This breakout has pretty much confirmed every cyclical bear market since 1950. When we get this breakout above the moving averages, test, and then breakout again, that's generally a very, very bullish sign and usually confirmation of this bottom. Now, there are a couple things to look at on this chart. I did put the Fibonacci in here from the very top down to the bottom, and we've already gone past the 38.2% retracement area. We could get close to this 50%, and I tell you, if we break through the 50 without a pullback, I don't think this thing's coming back down. But maybe we get up closer to the 50. Maybe this is it intraday today, and we pull back, get a little test. But I think the next move up is going to clear that 50% retracement, and eventually 61 is going to go. Some people look at these Fibonacci retracement zones and look and expect that the stock market has to turn. Well, if you've bottomed, it's not going to turn. They're going to go right back to new all-time highs. That's what happens after cyclical bear markets. So, and I do think later this year or in early 2023, we will be at a new all-time high on the S&P 500. No doubt in my mind. We'll see. Second chart I want to show you. This is a really important chart because when I look to see the S&P 500 direction, when I'm trying to figure out the direction, I like to look at the XLY versus the XLP for confirmation. It's one of the what I call sustainability ratios that I like to use. So when prices are going down and I've got these vertical red lines highlighting the low closes on this move to the downside, there's a low bounce. Here's a low close bounce. Here's a low close bounce. Here's a low close and then back up. These are the areas that I want to focus on. At each one of these first 3 lows, look at the ratio between the XLY and the XLP. Very, very bearish. I mean, This is money rotating out of consumer discretionary and into staples. That's why this ratio keeps going lower. This just makes common sense to me in a bear market. You don't want to be in discretionary stocks, growth stocks, discretionary stocks. These stocks are getting killed in bear markets. There's the rotation coming out. This is the sustainability. This move down is sustainable. We bounce, it's temporary. We go to a new low. All right. We're at a new low here. This is still sustainable. We bounce, it's temporary. We go back down to a new low. The XLY XLP is at a new low. Again, sustainable to the downside. We're going to go lower. We bounce, it doesn't last. We go lower. A lower low? No. We went higher. And even when we did have one more period of weakness, this was starting to get a little worrisome. We held. We never went to a new relative low. And now look at what's happening. As the S&P gets up and threatens the early June high, this ratio is already above it. This is telling me we're going to make the breakout, whether it's now or later. We're going higher. Again, this is one of the signals I use. Nothing is a guarantee. This doesn't mean that we are guaranteed to go higher. I don't want anyone to think that. What this is telling me is that the risk, Wall Street's getting into discretionary stocks versus staples. Why shouldn't we? They're not telling us that on CNBC, but they're doing it with their money. This is the important part. At the very top, look at what was happening. The S&P made a final high at the end of December, early January. Look at that final high. What was Wall Street really doing, though? They were rotating out of discretionary. They weren't telling you, they weren't telling me, but they were doing it with their money. And this is how you see it. Follow the sustainability ratio. This is really important. Next chart. This one I'm just kind of so-so, but if we're truly going to go higher, our economy should be on the rebound down the road. We should be strengthening again. We've had 2 negative GDP reports in a row. I think this is telling me we're going to go higher. I think a secular bull market, that's what that's telling me. We're going to go higher. If that's the case, we need transports to start working out. They've been going sideways. They've been all kind of up and down all over the place, but really just going along for the with the market for the last 2 or 3 months, which isn't bad, by the way, because the market's going up. So what's going up here, or what's going on here with transports? They're going up. Went through the moving averages, tested the 20, breaking out to new highs, breaking out again today. I think this chart looks good. Fourth chart, technology versus the S&P 500. This is a 10-year weekly chart of the relative strength of technology versus the S&P 500. Now, on this chart, you can see we've been in a secular bull market, and generally technology leads, but we go through periods. We went through the trade war in the 2018. That was rough. Early part of all the inflation worries, first 3 months there, really rough. Back second quarter 2016, rough. End of 2013 or end of 2012 and into 2013, rough. But I want you to look every time that we have had the PPO, the relative PPO, turn up and cross the trigger line. Trigger line's the 9-day moving average of the PPO. Every time we've had this cross, now here, relative strength was weak for just a bit, maybe one more quarter, slightly, and then we were back off to the races. Here, it was time to jump in. Now, this was off the center line. These were all breaks back below the center line. So I'm only looking at those 4, below the center line and at the center line. All of these, when we cross back up above, you want to be in and moving and into technology. We just did it, and we're just starting back up again. Technology, that's why I think it's going to be a leader the rest of this year. The last thing is growth versus value. This is large cap growth versus large cap value year to date. This is mid cap growth versus mid cap value, small cap growth versus small cap value. As you look, they keep putting in lower lows all year until May, just like the XLY XLP, but then we started turning up before the S&P made the final low. Again, Wall Street moving into growth stocks. Why would you do that? Because the market's going higher. That's all I got for you today. Listen, join me later today, 4:30 p.m. Love to have you. go to earningsbeats.com, sign up over there for the free Earnings Beats Digest newsletter. I'd love to see you. Happy trading, everybody. It was a pleasure being with you today.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.